You're listening to the Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Market Moose? Mike from the Moose on the Loose. I hope you are doing well the day that you survived tariff day. Today we're going to talk about my number one trick to avoid investment mistakes, or I would say like losses, or both of them. I mean, I'm pretty sure that you're like me. I hate losing money on an investment. And unfortunately, it happens. And it happened in the past several times, and it sucks, right? Every single time that you invest in a company, that's a major flaw of investing in stocks instead of like just buying an ETF and never do anything going forward. When you buy stocks, you need to do research, and then when you do research, maybe you have some oversight and you cannot simply not predict the future, and you end up losing money. So I hate losing money. I hate making investment mistakes. And here's like one of like the good trick is to reflect on your previous mistakes. And that's what we're going to do today. And actually, it's kind of funny because I have like a little bit more points about this later on, because I got a very, very good tip for you to avoid a lot of investment mistakes. It's not going to solve all the problems, but we're going to get there later on today. So when I was young, so we're going to go back in time. I started investing in 2003, so in my young early 20s, and I just thought, well, you know what? I'm working for a bank. They're doing investment loans. I'm not that stupid, so let's do an investment loan. So I pulled out like a line of credit, took like $20,000 out of the line of credit. Was supposed to be like 3-4, but then I had like no strategy. That was like a big problem here. I was just like passionate about investing, and I had like a bunch of friends that shared the same passion. So I thought, well, might as well just start investing on leverage, and it's going to be fine. Fortunately or unfortunately for me, between 2003 and 2008, while those were like the good years, right? Super easy to make money. A monkey would have made money. It was like everything that I was invested in was making a ton of profit. So buying, selling, researching, having fun, thinking that investing, it's kind of like just doing a little bit of research, just buying in when you make a good profit after like 20, 30, 40% in. Okay, so you got your profit, you can sell back and then move on to something else. This is usually the thinking that you start to have when you invest in a bull market and you have not gone through any downturns, right? So the first thing that I've learned throughout those years between 2003 and 2010 actually is penny stocks, not for me. I invested in penny stocks. I got burnt, like literally big time burnt, and I've discussed that on the show. But long story short, I invested in a mining company. They got bad results. I lost like 50% of my investment right before buying a house. So that was not a good timing, not a smart move. So I've learned the hard way that investing in penny stocks could be super exciting and super costly. The second thing that I've learned as well, as I told you, I was sharing this passion with a lot of friends. Well, investing on friends' tips. So sometimes like it's a friend, sometimes it's family, sometimes it's like just a guy that you follow on YouTube or whatever, or even on the Moose and the Loose. You're just like listening to me, and then you're saying, oh, Mike, you've just reviewed this company. It looks interesting. So I'm just going to buy it. Well, if you do it that way without doing your due diligence, you don't really know exactly what the company does, what's the playbook, what's the risk, right? I actually did an episode on Tuesday on that, on how to craft your investment thesis. So you don't want to miss that. You want to go back to Spotify, Apple Podcasts, or wherever you listen to the Moose and the Loose and listen to Tuesday's episode. Super important. Anyways, so I did that for a few stocks, buying on hype as well. So a lot of like trendy stocks. I even bought in like a company that was in uranium. So uranium was going to be the future, the energy of the future. It's going to be like amazing. Yeah, and I lost a lot of money. So two things here. not investing on listening to on friends tips, on hype, on commodities as well. That didn't work out for me very much. And I'm still talking about that period between 2003 and 2010. That's kind of crazy, but I made like a lot of money during that period, but also made a lot of mistakes. The last one that I did was to try to catch a falling knife. I bought Research in Motion, now trading as BB.to on their BlackBerry, as it was going down. I thought, well, they lost a lot of value. That seems like a very interesting value play. Let's buy in some more, and it's going to bounce back, of course. Well, I learned the hard way that catching a falling knife is dangerous, and you have to be ready to lose more money than being ready to win money, and just thinking that a good investment, that a company is a good investment just because you like a product or because you see that it trades at a very low value in terms of PE ratio, that's not enough. That's definitely not enough. You need a full investment thesis. You need a full set of robust investment metrics. And I got all of that. And then I got smarter. I got smarter in 2010 because I decided to build a real investing strategy, not just buying and selling and just having fun on the market, but rather having a focus with metrics and investment rules. Everything, of course, built around dividend growth investing. So in 2010, this is where I started dividend growth investing. And you can tell now it's been 15 years and counting. I have the same investment strategy. So, of course, the strategy evolved a little bit. I had some tweaks. For example, at the very beginning, I had like a maximum payout ratio. I don't have that anymore. I had a minimum yield. I don't have that anymore. But the global focus was the same. Companies that are paying a dividend this year, and that dividend will increase next year and the following. So that was like the biggest change of my life. It helped me a lot having a much better approach to investing, better returns as well. Spent less time researching. That's even better. So that was really great. But still lost money, still made mistakes. It's not like perfect, but having a strategy enabled me to invest with a lot more conviction and let my winners run. So that was like a big thing. At the beginning, I was like just cashing in my profit all the time, thinking, well, you don't lose money when you're cashing a profit. Yes, but the opportunity cost is huge. So letting my winners run actually help erase most of the mistakes I've made. So I kept on making investment mistakes, less of them, and also with smaller position in my portfolio. So most of the time when I'm not sure about a stock, this is where I have like higher chances to make a mistake and lose money. But those did not had a major impact on my portfolio anymore because they were smaller position. I knew I was taking additional risks, so I was investing accordingly. And because I had very strong winners, well, then it didn't matter that much. I mean, it's like when you play baseball and you are 3 out of 5, so you got 2 strikeouts, but you hit the ball 3 times out of 5 and you end the game with 5 points. Well, nobody really cares about the 2 strikeouts. Yes, you made mistakes, but your wins are a lot better, and in the end, you achieve your goals. You won the game. So achieving your investment goals, following your strategy, and achieving your retirement plan is a lot more important than outperforming your friend, outperforming the market, outperforming everybody. That sometimes it's a good bonus, but really it's not a guarantee. It's not always easy to do that. And I mean, some years I beat the market, some years I don't. But so far, I've been able to be ahead of the overall market since I shifted my strategy in 2010. That's a bonus. The most important thing for me is I don't have doubts, so I sleep a lot better at night. I keep everything simple with investment rules that are focused again the same strategy, and I don't have to mind about the noise. So whenever the market goes down, I'm like, okay, the market is down, so that's not a big problem, and I can continue to invest with a lot of conviction. So number one trick to avoid making mistakes is to reflect on the past times that you have made you lost money, so you can realize what went wrong. So for me, I realized not investing on hype. Commodities, I'm bad at it, so let's not touch too much commodities. falling knives, super tempting, but probably a good place to lose money. And then the number one, the second trick that I have for you guys is to have a clear and straightforward investment strategy and to stick to it. Not having like, 30% of this, 40% of that, 20% of this, and then, I'm doing a little bit of on the side. That's not an investment strategy. You need something that you can focus on, and that works. All right, Moose, that's enough for today. Tomorrow, it's Retirement Friday. I'm going to cover 3 of my favorite income products for retirees. So once I retire, how would I set up my portfolio? Which kind of products would I select to create the income I need to retire stress-free? So that's what will be tomorrow. And until then, don't forget to stay invested.
Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.